Wowzers, we're seeing that 90% of all inflation is being driven by housing, but there's a much larger problem that might be lurking in the shadows that a lot of people aren't talking about. And I want you to see why nobody can see it coming, and most people think that inflation is going to become a problem all over again. Only a small handful of us believe that a bigger, much larger problem might actually be coming from the exact opposite case. You see this piece right here from Business Insider. The U.S. could see inflation drop like a rock without hitting a recession, says Bank of America. Notice that they say without hitting a recession. They say, but this time around, the indicator is signaling a hard landing for inflation, not for the economy. Looks like somebody's optimistic. They seem to think that this time around, referring to the yield curve inversion, the indicator is more reflective of inflation itself rather than the economy. Now, it's hard for me to come to terms with this. The only time when the yield curve inverted over the last 50 years and we didn't fall into a recession was in 1998. It only inverted for a month. Now here we are at 18 months of an inversion and at the steepest spread between a 10-year and 2-year in 40 years. As things stand right now, inflation has effectively dropped like a rock already. This is because the latest CPI inflation report shows that 90% of all inflation is coming from shelter inflation. If you cut that out, inflation is effectively zero. So yeah, inflation has already dropped like a rock, but it doesn't mean that we're out of the woods yet. One thing missing from this piece of the puzzle is demand, and we got a lot to talk about. And to begin that, we take a look at something else being reported by Bank of America. They say that small businesses are less optimistic. And what we're seeing is small businesses, well, they're going to be echoing the sentiment that things are really getting bad and then going to get worse. And guess what? That leads to lower spending. Small business sentiment dropped to the lowest reading since 2013. This was partially driven by weaker sales revenue and continued pessimism on economic outlook. The bottom line, if you're a small business owner, the survey is pretty simple. If you're seeing demand for your products and people are coming into your store and buying stuff, well, then your optimism goes up. And if you don't, your optimism goes down. And right now, that sentiment is so bad that we're at the lowest level since 2013. But what's really driving this is related to the consumer. Of course, small business owners are just falling, finding out that consumers just don't want to spend. But Bank of America asks the question, why is sentiment important? When sentiment dips, companies hesitate to spend. This isn't just about salaries, it's also about expansion efforts. A recent report on small business owners revealed that 42% of them are reconsidering their spending habits. So relate that to personal finance. When you're uncertain about your financial future, don't you recess and cut back? Just like when we cut non-essentials from our budget, businesses do the same. This behavior reduces overall consumption, exacerbating economic stagnation. But what's the key here? The trend is that consumer sentiment indicates tougher times for small businesses ahead. Survey trends for small businesses look grim, indicating that they're going to cut spending even more. If things don't improve, they might start laying off staff, indicating a domino effect. What starts a minor economic hiccup could snowball, causing faster deceleration. The latest survey highlights weakening in investment and hiring, indicating a payment slowdown. Bank of America confirms this. Small business payments, including ACH, cards, and checks, have dropped 8% since last year. That's pretty significant. But it's worth noting that payments were high last year, which skews this year's data quite a bit. But the decline is undeniable. Specifically, when you hone in on ACH payments, they fell by 4% year over year. It's the first drop since January 2021. So much for a post-pandemic boom. The numbers indicate an ongoing deceleration. Here's the kicker. If we compare retail inventories to advanced retail sales, you can see advanced retail sales are coming down. But if you look at inventory growth, well, it's still running somewhere about 7-8% a year in growth. So what we know is that retailers have way too much inventory. They're going to have to cut prices. And they're going to have some deflation in there. And if they don't move this inventory, based on the data we see now, we're on the verge of a contraction in retail sales, telling us the demand is going nowhere at a time when inventory growth is astronomical. So you can imagine the small business owners are going to be screaming here in the months to come. When they're just loaded to the gizzards with inventory, the next thing you know, their stores are empty. It's going to be a huge problem because these small business owners are going to need to access credit markets to keep afloat. And all of a sudden, things are drying up. And this is where we get to see what actually happens after a yield curve inverted. You see, new money is created when commercial banks lend. So you see a slowdown in commercial bank lending, you see the slowdown in money growth, and then the next thing you know, you face a ticking time bomb of musical chairs when it comes to debt repayment. And at some point, you start to see delinquencies show up and eventually defaults. And of course, the banks themselves, the smaller banks, they've got a big problem because they're not seeing deposits grow. So the next thing you know, you've got a banking crisis and a financial crisis and a recession all at the same time. And central bankers have finally cracked the inflation mystery. And trust me, it's about time. Clearly a bunch of nincompoops. The Wall Street Journal reveals the top economist's big reveal on an inflation conundrum. And guess who weighed in? Our old pal, Ben Bernanke. For 2 years, they've pondered if government stimulus or pandemic disruptions caused surging inflation. Meanwhile, we've known this the whole time. These experts? Dude. Inflation spiked in 2021 due to a hot economy from stimulus and low interest rates, even if borrowing wasn't huge. For inflation to dip, the economy's got to chill, leading to more people heading to the unemployment line. Think about it. Limited resources, people with cash, fewer folks working. They buy everything up and inflation soars. It wasn't rocket science, but it took them forever to see it. They think a cool labor market will ease inflation. Doubtful. Here you can see in this chart the consumer price index on a year-over-year rate of change against a 4-week moving average of initial claims. And what we can note is that throughout history, when inflation comes down, at least in modern history, when inflation comes down, you can see the 4-week moving average of claims is rising. You see it happening over and over and over again, and it's happening right now. Unemployed folks with slashed incomes spend less, and the cycle continues. And a lot of what we're going to be experiencing starts with China. You can see a lot of where the global economy is headed starts with China. Now look at this. Shelter inflation may go negative next year, a Fed study finds. Again, this research report says it could go negative, and that means deflation in the housing sector. Now, that doesn't make a lot of sense because what we're hearing from all the experts is that inflation is going to rear its ugly head again. They're saying if the Fed doesn't keep its aggressive press on higher interest rates, all it's going to do is pop back out of the bottle and we're going to have another fight against inflation all over again. That's the broad narrative. And yet what we see here is this report coming out and saying, well, maybe that's not actually going to happen. Our baseline suggests that year-over-year shelter inflation will continue to slow through late 2024 and even turn negative. That'd be deflation by mid-2024. This according to San Francisco Fed economists who wrote in a note published on Monday. This would represent a sharp turnaround in shelter inflation. And again, with important implications for the behavior of overall inflation. And the question is, why is that? Well, because shelter inflation is a huge component of the consumer price index, which I'm going to show you in a bit. But I want you to see how its lagging effects could really push some downward pressure on the index at a time, again, when everybody's expecting inflation to come roaring back. And you can see here in this chart, we've got 3 lines. You've got consumer price index, that's headline in blue. Then we have core inflation, which strips out food and energy. And the third in green is shelter inflation. And what I want you to see is that usually the core CPI is lower because, as we know, its components are due to energy. And then the core CPI lags to the downside. But what you can see is housing, that's shelter inflation. It lags all of them and generally does. But normally what you can see today is that this shelter component is rolling. Just starting to roll over as headline is crashing down and core is coming down, and this is expected to take a while. As the Fed says, perhaps into 2024 it gets even down to normal. It's a lagging indicator. It just takes longer because, of course, this shelter component, which is a big factor, it comprises more than 40% of the core CPI, and it's an important part of the battle. So we see here from the Fed that says, wait a minute, maybe until say, mid to late 2024 before we start to see things moderate in this space. And yet that's going to put pressure on the Fed because, as we know, Big Daddy Powell, what he wants to do is keep those rates up. He actually wants to hike them, and he wants to keep them at this high level for an extended period of time. Well, if that's your objective and you're the Fed chief, well, what benchmark would you want to use? You would want to use core CPI because of this big overweight part, which is the housing market, which you already know from your Fed research reports it could take over a year to get back down to zero inflation and even go negative. Well, again, if that's your goal, what you got to do is keep that funds rate up. And that's why we're seeing the Fed make these decisions, because it wants to keep these rates higher. So they're talking about inflation dropping like a rock and everything is going to be peachy. Well, if it all drops like a rock, including shelter, they're going to hope that it doesn't drop through the floor, because deflation could become another concern. Because with uncontrollable deflation, you get bank failures, you get corporate bankruptcies, and you get double-digit unemployment numbers. Well, let's clear the air. There's no magic data saying inflation will shoot up. We check out China's producer price index. We chat about this often. It spiked up recently, right? But it did the same dance a few months ago and even before that. And guess what? It didn't sway the overall direction of the consumer price index here. But we got to remember, when China's producer price index shifts, it affects our consumer prices. Why? Well, because a lot of stuff is made in China. Some folks are buzzing thinking that the latest spike in China is signaling an upward trend. But if you look closely, there were many tiny spikes before. But their bigger trend still downward. It's all about supply and demand, not just inside China, but outside too. In places like the US, Asia, South America, Europe, just everywhere. The word out on the street is that demand is dropping. So when we checked out last week's CPI report, what did we expect? A drop? Well, it wasn't exactly that. Maybe it's just another tiny spike hinting at a downward trend. After all, the US core CPI hit its tiniest growth in 2 years. Now, what's important to understand is that in a debt-based economy, when banks tighten lending standards, remember what that means. That means they originate fewer loans. And that means less new money is created. If there's less new money being created, then there's less money for economic growth and less money to service all debt. And if there's less money, that means there's less demand. And if there's less demand, what happens to CPI? It goes down. And here we have another article saying investors are making the same mistake they made during the dot-com and housing bubbles. Further consider, investors are so excited about stocks that they're missing the bigger, grimmer economic picture. And she pointed to a surge in bankruptcies and mounting pressures in the bank and real estate sectors. Stock enthusiasts are so wrapped up in the rise that they're overlooking some serious economic signals. It's kind of like missing the forest for the trees. The analyst Danielle DiMartino Booth says this feels a lot like the dot-com and housing bubble blunders we've seen before. Why is everyone turning a blind eye? Well, with the stock market shooting up, it's tempting to think everything's peachy. But Danielle says it's not. She told BNN Bloomberg, with stocks this high, we're forgetting the real deal in the US economy. And this isn't the first time. She mentioned we did the same in 2000 and 2007. You know the saying, the calm before the storm. Danielle thinks we're right there in that calm. Check this, the S&P 500 and NASDAQ soared 19% and 36% this year, driven by all the techie buzz and folks thinking a recession is not on the horizon. But the truth, Danielle points out some real weak spots. More companies are going bankrupt now than we've seen since 2009. Also, those big property folks, they're struggling big time to get money, especially with banks being cautious. Danielle, who once advised the Dallas Fed, believes more banks will face tough times. She adds that many small banks are drowning in commercial real estate assets, which aren't worth much nowadays. Why? Well, everyone's working from home, and borrowing's gotten trickier and pricier. And then there's a tussle between the Federal Reserve, who's trying to handle inflation by upping interest rates, and the Biden team who's splashing cash years after COVID first hit. Danielle's take, Uncle Sam spending faster than he can borrow. Last year, inflation hit a 40-year peak of 9.1%. The Fed responded by raising rates. But now, with inflation slowing at 3%, there's hope they might slash those rates soon. Opinions are split among the experts. Some, like Jeremy Siegel and Paul Krugman, feel a recession is not coming. But others, including Danielle, think we're headed that way. And she's not alone. Folks like David Rosenberg and Jeremy Grantham are in her camp. So as you can see, there's a combination of things that don't look good. Plummeting demand, maybe some deflation here at home. We just got that recent PPI report on Friday, and it shows that the producer price index for the previous month was revised downward. So yep, a path towards deflation. We're also importing deflation from China, a money supply contraction that I've talked about in previous videos, a weakening labor market, a loss of value in commercial real estate. I started this video off by saying Bank of America thinks that inflation is going to be the only thing that drops like a rock. Well, I hope they're right, because it looks like the entire economy is going to drop along with it. And then we're getting into supply chain and shortage issues related to food. I made a couple of videos about that issue that you can watch at the end of this video. And on top of that, there's record credit card debt and common delinquencies with auto loans. I haven't made any videos about that topic, but that isn't to say that it isn't part of the equation. We've got a lot of stuff counting against us, and it looks like everything is going to be coming to a head in just a few months. The only thing we can do is try to prepare. Get rid of any consumer debt if you have any. If you're all prepared already, then get ready to win big, because it could be a magical time if you want to invest. If you're going to be successful in an economic downturn, or in any time for that matter, you have to try to maintain a growth mindset. What's really important about a growth mindset is that you believe that your intelligence and your capabilities, and essentially your potential, isn't fixed, but rather you can influence and adapt and continue to learn and grow. You see, one of the biggest differences between those who are moderately successful, or even those that are just even scraping by, and those who are incredibly successful is that the incredibly successful people have an incredible, insatiable curiosity. They want to learn, they ask a lot of questions, they're always reading, they're always consuming new information. Try to maintain curiosity, ask a lot of questions, try to learn what other successful people are up to. Act like you just have no other option but to be incredibly curious about everything around you. Always have Bloomberg or some type of news channel or a stock market report on the TV or radio. Always think about different sources of news, magazines, different books, and all sorts of different educational and current events to keep you up to date. Always learning and essentially filling your mind with the most relevant and valuable information possible. If you want to be successful or incredibly successful, you got to possess a growth mindset. You have to prioritize learning and consuming as much valuable and informative content as possible. And that's the important part, right? It has to be valuable and informative content and really strategic. Because as great as it might be to consume content just for the fun of it, if it's really not progressing you further towards your goals, then it's really not going to help. And speaking of consuming valuable content, make sure you check out some of my other videos. After you subscribe, of course.